All right, welcome to the Sherman Show. I'm here today with my co-host, Sam Lau.
Hey, hey.
And we are broadcasting live. I guess we're always live, but I like to say it when we actually have the videos rolling. We're here in Chicago with none other than Jim Bianco. How are you, Jim?
I'm doing well. Thanks for having me.
Welcome. So we're putting this on the YouTube channel, so those of you that are listening to this want to watch and see what we actually look like today. It's at youtube.com/DoubleLine Capital. You can see some of our videos. Jim was out at our first inaugural, I guess, is it first and inaugural, but the inaugural Roundtable Prime in Los Angeles a couple weeks ago. And so given we're coming here, we thought we'd follow up and kind of continue some of that dialogue. So thanks for joining us, Jim.
Yeah, thanks for having me. I hope we don't scare too many people away that they get to look at us instead of just listen to us.
Yeah, so again, if you're watching this on YouTube, feel free to go to the audio-only version, and you don't have to suffer through all this. But so, we started talking, before the camera started rolling, we were talking about Davos. And so you said, did you hear the great news out of from Bob Prince today? And I read the headline. I didn't really go much deeper into it. Maybe you can tell us what you're hearing from Davos to start us off.
Yeah, the news today was he was interviewed this morning on Bloomberg TV, and he proclaimed that there will be no more boom-bust cycles anymore, and that so we've got the end of the business cycle.
Yeah. Wasn't that kind of what Yellen said too? There'll be another. Yeah, I think she said another financial crisis.
No financial crisis in our lifetime.
I mean, things are just looking up in the 20s already.
Right. Exactly. I thought the best. Of course, we all know that history is riddled with people that have proclaimed the end of the business cycle. The famous one was Irving Fisher, the economist in 1929, who said that we're at a permanently high plateau. And a few weeks later, we had the stock market crash and the Great Depression. But they had Carmen Reinhardt on after him, and she was the co-author of the book This Time is Different with Ken Rogoff.
Yes.
And she said that the first instance of somebody proclaiming the end of the business cycle was the King of Spain in 1588 when the Spanish Armada was created. And he said, there will be no more business cycles now because we've got this thing. And then it sunk a few months later when they had a business cycle right after that.
So are you here to say this is the top? Is that what you're saying?
I think that, to be serious about it, right. I've always joked that the last person you should ask if we're going to have a recession, because they're the most unqualified, is an economist. Because an economic expansion should continue forever. Grow fast, grow slow. Look at Australia, 29 years without a recession. But they never do. And the reason they never do is something breaks them. A political instability, a financial crisis, a supply shock in energy, all of the above, which is sort of what we had in 2008, those things happen and you can't really predict them. So yes, the economist will tell you everything's all systems go, the economy looks good, I see no events on the horizon until we have a financial crisis, or we have political instability, or oil prices shoot up to $200 a barrel.
Or a coronavirus. Or we're talking about this week, right?
Yeah, or the coronavirus winds up being really serious. Yeah. Or a war. Yeah. A war is another one. Then you break the economy and you have a recession. So yes, they always continue until something breaks it, but human nature is it's hard to go more than about 10 years without breaking it. Yeah. We've got a record expansion going. There's no reason to think it won't continue, but like you said, by the end of this week, the coronavirus could metastasize out of control, or something else can happen, or something in the Middle East and there's $150 crude oil, or something that none of us can continue or contemplate, and voila, we've got a recession on our hands.
In the past, I think you're the one that said the central banks, or the Fed specifically, is a serial killer of economic expansions as well. Was that you that said that?
I quoted Ben Bernanke that economic expansions are often murdered by the Fed, is what he says. And there's a lot of truth to that, because the Fed will have too tight a policy, an incorrect policy, fearing inflation, and they break the economy. One of the risks I think that the economy has right now is the Fed. This whole QE, not QE debate. I think that larger in this debate is the Fed is playing with tools that no one really understands, least all of them. Their giant balance sheet, and someday they're going to have to pull that balance sheet back. We don't know what that's going to unleash. They don't know what that's going to unleash. I've talked to Fed officials.
But are they ever going to really actually let it unwind?
There is an event that will cause them to let it unwind, the return of inflation.
Okay.
If we have a return of inflation, they will then be forced to, I think, unwind it. They say two things. they say, well, we've modeled it and we think we know how it's going to work on the unwind. And I said to them jokingly, yeah, I could make up numbers in a spreadsheet too, and that's my model as well. and as far as they're going, well, as far as inflation goes, we might move to an average inflation regime. Now, that's techno speak or Fed speak for they've got a target of 2% that they might subtly later this year change it to an average of 2%, which means you can go above 2% for a little while, below 2%.
Yeah, but what's the look back period on that? I mean, that's a huge difference, right? Too, right. It depends on how you think about it, right?
Exactly. And they haven't been, the inflation rate hasn't been above 2% since they adopted the target in 2012. Yeah. And I joke to them, I liken that to the drill sergeant saying, yeah, these green troops, they've been drilled at Fort Benning and they're ready for action. And then the minute that they get into actual combat, they soil their pants and everything goes out because it's not the same. It's easy to say, we'll have an average 2% target on inflation when you're at 180. And you're at 180 and you're 180. And then it goes to 250 and the markets are getting kind of wobbly. You're going to go up to the microphones and say, nope, average and target, we're not going to move. I don't care if the market doesn't like this. Of course you will, and stuff. So good luck with that one as far as the Fed
doesn't
goes.
It really look like we're going to get to, close? I mean, look, I know you're focused on core PCE. I mean, if you use the core CPI, we've been really running above that 2% rate for about 2 years now, right?
That is correct. Right? But the Fed's target is core PCE.
Fair enough.
That's what they created. They created this Frankenstein by using that target. So if they want to switch to core CPI, they could tell us, and then they could tell us whether or not that 2 still applies, because historically CPI runs about 30 to 50 basis points above PCE. So I assume they would go to core CPI and say it's 250 or 225 or something like that.
Right, but it's just arbitrary then anyway if you're just using that kind of average differential, so why even change it, right?
Right, exactly.
Right, so let's talk about that idea of inflation too. And so what would it take to freak out the Fed at these levels? Like, is this a number with a 3 handle on it? Is it 250? That you just mentioned, or is there really something in the psyche where they think they have it all under control?
So let's put some numbers on this. We're at about 180 or so on core PCE. That's their target is 2. They adopted the target in 2012, and it's been above 2 exactly 1 month in 7 years. Yeah. That was 2018.
The summer of 18. Because I just said Powell should go out and take the victory lap. He's the first one to ever accomplish it since they set the target
for 30 days. Yeah. And then it fell right back under.
Right. Hey, take your victory lap, though, right?
If it goes to 240, that's core PC was to print 240, that would be a 29-year high. So that's how far we'd have to go. Now, that would be 50 to 60 basis points higher. That would mean core PCE would probably, in kind, go 50 to 60 basis points higher, and it'd be close to 3.
You're saying CPI.
CPI, I'm sorry. CPI would go up the same amount, roughly the same amount, and it would be close to 3. That would be the high point of inflation. That would be, the Wall Street Journal saying 3-decade high in inflation and stuff, and that's when you'd have to get that conversation. Now, you may say, well, that's only 0.5% away, but it's been 0.5% away for 9 years. Sure. We've been waiting 9 years for it to come up. But I think to answer your question, that's what it would take to really get the question moving, and it hasn't yet happened.
Yeah, well, I mean, it just kind of begs the question about the Phillips curve. I know we talked about this the last time you were on. We were doing it remote. You talked about that, well, you have to have the Phillips curve in order to have consistency of the messaging. But we've seen now wages, they've been growing roughly 3% a year or so.
Right.
You saw some kind of dip down in the last numbers, but it's still 3%. It's still running above inflation. So, I mean, is the Fed really concerned if wage growth is there, or is it just that it's fear of the model and the idea of this 30-year history?
I think that there was fear of the model, and I think they're backing off of it. Last year they did this whole Fed Listens tour, and this was all part of, as I termed it, nothing's working. Let's go ask some other people their opinion about what's going on. Hey, good for them. Yeah. At least it's a
conversation at least,
right?
Exactly.
Yeah, exactly. Don't be so insular that you don't even want to recognize when things don't work. In your business, in the money management business, that's the hallmark of somebody who's good at it. That the first thing you do is recognize that this isn't working, and you move on. Well, Central banks have been bad at doing that, so good for them that they went that route for right now. But I do think that they're backing off on the model. They're now saying that they're going to be a little bit more flexible. Powell, in particular, has talked about the idea of what the Fed officials call a high-pressure economy, running it hot because wage growth at 3% is above the inflation rate. And the administration has been touting lately that workers are making more than are getting more pay increases than their bosses. They want that.
Yeah.
They want that.
Now, that's good for the overall economy,
it's
though,
good
too.
For the
and
economy.
We've seen that in the lower tier jobs are the ones that have the highest
yes, that's
rate,
good
rate
for
of
the lower
increase.
tier jobs. It's good for the economy. That's a departure because maybe 5 years ago, the Fed would have looked at that 3% wage number and said, "Oh my God, we got to raise rates. We can't let this happen." Mm-hmm. But now they're willing to let this happen. And what's allowing them to do it, I think, again, is the low inflation rate. That's the pass that they can get. If we get the higher inflation rate, it'll be interesting to see how they handle it.
Right. So let's talk about what's in a name. We're talking about the Fed. So QE, not QE, what the Fed's been doing ever since the repo blow up on September 17th. So balance sheets expanded, a little more than $400 billion
Yes.
Since that point in time. The Fed has really said it's not quantitative easing, it's just liquidity facilities. It looks like they're turning into kind of permanent liquidity facilities. I think Clarida recently said, well, we're going to talk about it in the next couple of months. We're going to figure out what we're going to do with these facilities.
Right.
So first, is it QE in your mind or not? Or is it leading us to the path down QE? I know you've been critical of like Brainerd too, coming out and saying, well, we should go out to 2-year terms on the liquidity facilities and the like. So what's in the name here?
Yeah, so let's put a definition on what people mean when they say QE, quantitative easing. Yep. What they mean is the balance sheet affecting financial markets? That's what they mean. Because you can attack the question two ways, and I think the answer is yes in both ways. One, does it meet the strict definition of quantitative easing? Bernanke gave us one in 2009. He said anytime the Fed increases the reserves in the banking system and expands the balance sheet, that's quantitative easing. Okay? That fits that definition. Now, the Fed has been trying to say, trying to modify that definition recently by saying Bernanke's right, but he forgot the words long-term assets, 10-year notes, bills don't count. Okay, so now you're changing us in midstream. But if the question then becomes, okay, but is it affecting financial markets? I think the answer is yes on two levels.
Well, we've had great run in risk assets since that started, right?
Exactly.
Yeah.
I think level one is it increases, as you said, liquidity. Repo, for those listening that are not steeped in this stuff, it's a collateralized loan. You give me some Treasury securities as collateral, I give you money. It is the most common way to finance a securities transaction. If the Fed is stuffing the banks full of reserves by supplying repo to the banks, the 24 primary dealers, that's their universe, and then they go and they supply it to second and third tier firms as well too, they're encouraging securities lending.
Right.
Now, I mean, when I say securities lending, more than just stocks. I mean bonds and I mean alternatives and everything up and down the line. That should be a boost to risk assets. The second one is signaling, that they are signaling that they will not tolerate any inconveniences to anybody in financial markets. Pat Harker, who's the president of the Philly Fed, last week came out and was basically patting himself on the back in an interview saying, yeah, we did such a good job with this repo thing that the normal year-end volatility wasn't even there. We even squashed that all away.
Well, I love you said it too, because I remember in the last press conference, Powell was up there and saying, well, there's always these month-end and quarter-end spikes in repo rates. And to me, it's like, well, it's window dressing, right, for the banks to be able to clean up their balance sheet. So it's like we admit that I don't want to say rigged or it's gamed in the system, but it is. It's gamed. And they're saying, well, the gaming, we helped provide more liquidity to that gaming of the system, right? And that's essentially what they're arguing.
Yeah, exactly,
right?
Exactly. And when Harker comes out and says that even that normal month-end, quarter-end, year-end stuff, we've even gotten rid of that, he's signaling to speculate with abandon because there will be, if there's any problem, we'll take care of it. There's a phrase, you've probably heard of the phrase helicopter parent. I don't know if you've heard of the phrase snowplow parent. A snowplow parent is one that clears the path for all their kids, every problem that's out there. We have a snowplow Fed. They will clear the path of every problem in the markets. Hey, we won't even let a little wobble in repo and on December 31st get you worried as well. And the interesting thing about snowplow parents is if you accuse them of being snowplow parents, they get very angry at you. No, we're not. No, we're not. And if you accuse the Fed of being a snowplow Fed, they get very angry at you. No, we're not. But that's exactly what they are. And so that's signaling. Here's liquidity. We will not tolerate any inconveniences for speculation in markets. Is making people think, yeah, just keep going. If it gets wobbly, the Fed's got our back. And that's what they've got to be careful of. So on the signaling level, I think it helps to boost asset prices. On the liquidity level, I think it helps to boost asset prices. So if people are asking, is it QE, meaning does it raise equity or asset prices, equities in particular, the answer is yes. Final thought on that. I've always argued that the Fed cannot create a trend. So the market was destined to go up since September 17th. What they can do is make it go up more. They can't make a market that was destined to go down, go up. They can make a market that was destined to go down a little bit less or go down a little bit more, but it's still going to go down. So this market was going to rally. It's just that you're right. The rally since they announced this program has been, the S&P's up on an annualized rate, 55% annualized since this problem started. I don't think we'd be up 55% annualized without the Fed, but we'd still be positive.
I like how you say that since we're up 55% annualized since this problem started.
Right.
It's funny that you use the word problem in there.
Right.
So the Fed spent last year doing this kind of peer review, or as you said, just asking for help, looking for guidance out there. The ECB is under review now too on their policies. Do you have any insight on what you think that Ms. Lagarde and her colleagues in the ECB are going to try to do in this next stage?
Yeah, I think that they're looking at negative interest rates and saying, is this a good idea? And they've got the Riksbank of Sweden that basically announced, no, it's not, and they raised their rates to zero. So they're
while still buying bonds. They're still doing quantitative easing in your definition
as well. But
at
least it's a step in the right direction.
No, I agree. Like we loathe negative interest rates.
Everybody loathes negative interest rates because they're a distortion and they cause havoc in the financial system. So I think that the ECB is now looking at this, and if I had to guess, the way that central bankers are is that they probably behind closed doors are saying this is really a bad idea. But then they're like, so how do we declare victory and get out of this thing? And that's really what they want to do, is they want to just basically say negative interest rates are just a brilliant move, and the next brilliant move is to go to zero. And they were, and that's the way they want to do it without anybody saying, so you admitted you made a mistake. I think that's what they're trying to unfold with. The problem, if I could say, the problem that they're having with negative interest rates is what I call populist problem. The banks, especially the German banks, will charge, if they have a negative interest rate, that means if you deposit money in your checking account, to keep it simple, they will take money from you every month. They only do that for accounts over 300,000 euros. Why? Because if you can't put 300,000, that's about 500,000 US dollars. You can't put $500,000 under your mattress. If you have 3,000 euros in the bank, you can put that under your mattress. So they don't want to see wholesale withdrawals of small accounts. They don't want to be accused of being, anti against the population by punishing them with negative interest rates. But that means that they have now permanently put themselves at a loss. Their borrowing costs are going to leave them, if they have to pay zero on these accounts and receive money at negative, they lose money. And that's where you see in the bank stocks are down. The European bank stocks are near 30-year lows. So they're trying to figure that one out. The other thing Lagarde is trying to do, which is why I think they picked her, is they're hoping that she will use her political skills to lobby for more fiscal stimulus. And
that's what I've been telling clients for a while. She's a politician. I think that's, Draghi gave her the keys to the kingdom. He gave her that last rate cut, which was the market puked at, essentially, right?
Right.
He gave her infinite QE, said, here's what you can do. So it's easy to backtrack from there, but it's not easy to increase those things. So that political willpower, I think, is very important. And all you got to do is point to this country and look at how much fiscal stimulus we're doing. Right. And so in a equilibration of the monetary policy around the world, which it's all been coordinated, except we were hiking while they were staying there. I think it is important that they look to this model, and that's what I've thought is the baseline, is that they are going to try to get to zero. Maybe it's not this year, but they're going to have to start signaling to the market. And I think the Riksbank is the key thing to watch.
Yeah, the Riksbank has led, and I do think that they want to go to zero. What they're hoping for is some kind of an economic rebound. Any kind that they can just latch on to. See, the policy worked. Now we could go to zero.
Right.
Declare victory and go to zero is what they want to do.
Yeah.
But I think that Lagarde has got a problem to the extent that you were brought on to convince the Germans and everybody else to fiscally stimulate. Mm-hmm. And as of us sitting here talking, there's no movement on that.
That's
no
right.
one's interested in doing that at all. So she can talk till she's blue in the face to them over at Davos, and they're not going to listen to her right now.
Yeah, so I think that's kind of the big focal point too, is that if we actually get to if we get back to zero, let's say in the ECB, I do think that that's actually a positive for markets in general, just to say, look, this policy doesn't work. But I'm reminded of a paper I saw from the IMF last year, and it came out towards the end of June or early July of last year, and it was completely the opposite rhetoric. It was talking about embracing deeply negative interest rates in the next cycle. During the next recession, I think was the title. But what it was talking about is exactly the situation you were talking about with the banks, that they were saying that it's the central bank's job to set the policy rates, but charging the consumer, right? As you're talking about, you deposit your check in there, you get your paycheck, it gets taxed out. They're saying, well, that's not a political problem, that's a PR problem. You're better at customer service, little commercial bank here. So you deal with the customer and you deal with this. And what they were actually arguing for was creating the shadow currency. And so what they were saying is they were going to effectively peg the currency to a level. Let's call it 100 euros today. Well, you can keep your cash, right? If you want to shove it under the mattress, great. But when you want to turn that into ones and zeros in your digital bank account, well, we're going to have a reference rate. So if the policy rate, let's say, is minus 5% for simplicity, well, the 100 euros, if you want to put it back in the banking system, all of what it's going to be worth is 95 euros in 1 year's time.
Right.
And they're like, well, that's just a PR problem. It's a customer service relation issue. And I'm like, the hubris in this paper that I'm reading, it ironed me.
I remember you being quite angry.
Yeah,
coming back with reading that.
Right, and it's like, and it's just like, to me, it's this peak hubris of the central banks and these PhDs that are not in touch with reality. They're arguing this economic equivalence, but they're not rooted in reality. And so I hope that that is Lagarde's mission, is to get us off these negative rates, and that we don't try to do this like extreme level where they break the banking system.
So let me depress you a little bit. That was an IMF paper last year, and who was the head of the IMF when that paper came out?
It was Ms. Lagarde.
I know. She came out and praised that paper as well too.
Yeah.
So at least in her public statement, she's been all for this idea about.
But that's why she's a politician, right? You argue what is the status quo, right?
Exactly, right. And that's why I think that her vocal support of negative rates doesn't wobble markets like a Draghi would, because she's a politician, and when the wind changes, she'll change, and it'll all be okay. And that's kind of the way that people look at it. But I think, as far as that paper goes and some others, they fail to recognize that the entire financial system was designed with the idea of positive interest rates. We designed the system that way. I always used to joke that, if you were to go into a time machine back into the Renaissance, into Venice or into Florence, when they developed double entry bookkeeping and fractional reserve banking in the 15th century, and you were in the room when they created it. Now, it wasn't quite that momentous. It kind of evolved over time. And they said, so this is how we're going to do it. You put 100 Italian lire in the bank, and we'll set aside 10 in a reserve account. We'll use your 90 to buy other securities or to put out other loans, set aside 10, and keep leveraging ourselves up to make money. How's that work? Well, as long as we get a positive cash flow from all of those securities and all those loans, we keep making money with all of those reserves set aside for a rainy day. And if you raised your hand and said, well, what happens when interest rates go negative? They would have asked you to leave the room.
Right, that's heresy.
The world doesn't work that way.
Right.
But my point is, negative interest rates, if you want to keep them, You have to have a wholesale redesign of the entire financial system. It does not work with negative interest rates. We're not ready to do that. We're still in the period of this square peg called negative interest rates. We'll just keep pounding it in the round hole of a financial system that was built for positive rates, and it will be nothing but problems. And the last thought on that for you is, what has given the world a big out with negative interest rates is the big reserve currency, the U.S. dollar, has not been negative.
Right.
That would be the game changer. So I also bristle whenever I see these papers. Well, they've had negative rates for 10 years in Japan, and they've had it for 5 years in Europe, and the world is doing okay. I'm like, well, first of all, their economies are struggling. Their banking systems are a mess.
Their stocks are a mess. The banking stocks, right?
Yeah, the banking stocks are a mess. And they've got the giant out of the U.S., the UK, Canada, New Zealand, and Australia never went positive. The 5 English-speaking countries, I don't know if that's a coincidence or what, but they've never gone positive. Deutsche Bank has restructured its entire reserve management system globally, which is code word for no longer do we invest in German reserves in Germany and Italian reserves in Italy. We now invest them all in positive yielding stuff like in the UK and the US. Mm-hmm. We go negative, and then you'll see the real negative effects because we're the reserve currency, we're the biggest financial market on the planet. Then you will really see the markets quake, I think, if we went negative. I don't think we're going to go negative. What I fear is, what we were talking about before, something breaks and we get the recession. I worry what their response is going to be in a recession. But fortunately, we don't have that right now.
But you have someone like Bernanke, even Yellen, going out publicly talking about negative interest rate policy in this country. And at least I say Powell's rejected it. At least we can brush that off for now. But Powell won't be there forever, one. And he can change his mind too. And so when you think about that response mechanism, why do you think someone like Bernanke, who understands these crises, he's a student of the Depression, he studied the Japanese history, that's how we went to QE, and he's followed in the footsteps of the Japanese model. Why doesn't he see it? I mean, we talk about it, but is it just that he doesn't want to see it? Is it that that's his framework? What do you think?
If I had to guess, I think it's his framework. He doesn't...
It's the assume the can opener, the old joke, right?
Right, assume the can opener. Yeah, that's a good one. That's a good way to put it, because I think what he assumes is they look at, well, when rates go negative, this is what it means for the borrower. Okay, where does that loan come from? It doesn't fall out of the sky like rain. It comes from a financial institution that is structured to try and make a profit off that loan. How do they make a profit off that loan? And the Bernankes of the world, they don't go into that. They just assume the loan will show up. Here's the rate. Here's what it means for the person.
It's a spread, and it's a spread game. At the end of the day, and that's all it is.
And that part is just assumed, because what I've yet to see in any of the IMF papers or the BIS papers or the Fed papers is an analysis of how the financial system deals with negative interest rates. And the answer is not very well, is what they do. So they just assume, all right, well, rates go to minus 1%, and we'll just give you a minus 1% loan. Yeah, well, what bank's writing that loan? Right. What bank is giving me that loan? Oh, well, we'll just assume it shows up, and then we'll talk about the consequences of it. And yeah, I think you're right. If we had redesigned the financial system, and by the way, there is a way you can do it. It's called a fully reserved banking system that would work with negative rates. It's completely different than what we have now. Then you could talk about that. But by the way, a fully reserved banking system, for those listening, if you want an example of that, go read the Libra white paper, the Facebook Libra currency white paper of how they would reserve against Libra. They basically explain the fully reserved banking system, or go Google the 1933 Chicago plan. The University of Chicago during the Great Depression was pushing that the banking system would go fully reserved, because then they said once they did that, they could look at negative interest rates, which made sense. First, you change the financial system to accommodate it, then you could possibly do it. But that's how it would work. And the problem with a fully reserved banking system, without getting into the ugliness of it, is it opens the door for cryptocurrency. It opens the door for digital loans. It opens the door for the obsolescence of the current banking system. So Mr. Diamond, yes, you could be all for a fully reserved banking system, but then we don't need JP Morgan in its current form because it serves no function.
Right.
You can change it to a fully reserved system, but you have as much experience as me or my 82-year-old mother does with a fully reserved banking system, which means none whatsoever. We don't know how that would work. So that's the problem that they face. They just assume that the system can just handle it. And there is a limitation on the system, and that is when you hit negative rates.
Okay, so let's switch gears here. Let's move into the markets too. So we talked about risk assets. It's pretty amazing to me to see how much risk assets have run. That's corporate spreads have tightened in significantly since the summer. You talked about the annualized rate of return on the S&P, but what's going on in the Treasury market? What's your feeling about the Treasury market? We seem to be stuck here in this range. Center of gravity seems to be about 180. I think we're a little inside of that today. It's like 150 or 145 to 195 is where the 10 years really traded since we had the announcement of the new tariffs on August 1st last year, right? That's kind of been that new center of gravity. What does it take to get interest rates to break out of this range, one direction or the other?
Yeah, I've been a big bond bull for many years. I'm going to channel my inner Van Hoisington here,
okay.
If you know who Van is.
Yeah.
Very famous bond investor who's been bullish, I think, since the Reagan administration, and he hasn't been wrong. Let's put it that way. For the last.
And his
30
arguments are great. When you sit and listen to it, it makes a lot of sense why it's going to zero.
Right.
But we haven't got there yet.
I think that the biggest thing that keeps rates from going up is twofold: the lack of inflation to push rates up, and the relentless buying that we have of rates. And the relentless buying that we have of rates comes from the aging population. In the developed world, there are, and I'm talking about the US and Europe and Australia, New Zealand, there are 300 million people that are age 65 or older, and we're adding them at a rate of about 10 net from over those that pass away to net 10,000 a day. So that in 15 years, we'll be near 400 million people. Go to any financial advisor and say, okay, you're in your 60s, you're 65. What is the proper asset mix for you? And it's some version of a 60-40 portfolio. Every day, the wealth gets older. Every day, we keep telling we got to own some kind of fixed income leg in that wealth. If you look at the flows, I think it explains the flows, because the big question of 2019 was the stock market was up 31%. There was a net outflow. And everybody's like, FOMO. Well, wait a minute. If there was fear of missing out, why was there net outflow? Yeah. And the answer is because everybody's looking at a 60-40 portfolio. And since this leg's going up 31%, I can just keep selling it down to keep it at 60, and I keep reinvesting in bonds. So it keeps giving bonds a bid. There's no inflation to keep bonds going. And I think there's a limit on the spread. So if the 10-year German is minus 20 basis points, if our rates are going to go to 2.5,
that's got to go up to 50.
They got to go positive 50. Right. They got to move. They got to start moving north as well too, because I think we're at the outer limits of about 250 basis points over Germany to what we can do right now. So I think all of those things keep rates down. My other favorite statistic about that spread is the Organization for Economic Cooperation and Development. The OECD has data on all of the major countries' interest rates back to the 1950s. The U.S. has the highest interest rates in the developed world for the first time ever right now. So we are at those limits. What we need for our rates to go up is a global rebound. We need the rest of the world to close the gap with us. And then their rates would start to come up, and they can push us up.
I mean, the correlation between developed world rates has been just very, very high since really, I'd say about 13 or 14. I mean, it's almost lockstep. And so let me posit this. What if Lagarde was to move interest rates back to zero on the front end with policy rates? Could that be a catalyst to get rates up, let's say in the Eurozone? Or are we going to have this inverted curve over there where people still have this relentless bid?
If she was to move rates to zero, that could be a catalyst to get us higher rates. But let me caution that idea, and this kind of goes back to our previous conversation. Central bankers are kind of like a doctor. They will never give up on the patient. You never want to go to a doctor and say, look, you're stage 4, here's some pills to be comfortable. Now, go away and die. They will try whatever they can continue to try. So central bankers.
That was what Draghi said, whatever it takes.
Exactly,
right?
exactly. So they could say they're out of bullets.
Yeah.
Well, you watch when we have a downturn, how they're going to find more bullets and stuff. And so what my point of bringing that up is, I can't see her raising rates now because of the political blowback. Remember, she's a politician. Mm-hmm. You're raising rates, and there's all of these yellow vest protesters in Paris, and there's all these protesters in Lisbon, and there's all these protesters in Germany, and they're all mad about the state of the economy, and you're hiking rates? You don't care about them? That really plays a lot with the politics of them. They'll need a rebound in order to raise rates. They'll have to lag a recovery, not try and lead it by raising rates. Mm-hmm. The Riksbank can do it because they're small. And they're kind of a one-off, and they're not going to get you're not going to get global protests over them raising rates to zero.
Yeah. Oh, it's kind of like when people adopted the Icelandic banking model. It's like, but that's Iceland,
right?
I mean, it's not going to drive the global economy.
The GDP,
you can have a bad bank there, right?
Right. The GDP of Cleveland is larger than Iceland.
I don't know that statistic, but I wouldn't argue it with you.
I remember that from Michael Lewis writing about it. Okay. He had that in one of his books.
Oh yeah, because he told that story about everybody being named Igor too.
Yes.
Right? When you're in the bar, and it's like, and somehow like there's 40 people in the bar named Igor, but when you say Igor, they seem to know which Igor you're talking about.
Yes.
And it's not like an inflection or anything. It's just that part stuck with me.
And he also talked about how when you take an Icelandic fisherman and how difficult that job is, and you explain to him what it is to be a hedge fund manager speculating in currencies. Sign me up. What an easy job.
Well, there's a lot lower mortality rate, I think.
Exactly.
In one of those professions. So coming back to that, so you talked about the 60-40, and you brought this up at the round table a couple weeks ago, and it really resonated with me because it's this systematic approach that the financial advisor anymore, there's not a lot that focus on security selection or a lot of it's just index buying. It's this the static allocation, and they're there to really just educate you that investing is the most important thing, which I agree with. It's the process is very important. Get the asset allocation right, sure, but you got to do something. So is it at some point does the system break because of just this group think that we've all been trained to follow this? Here's the algorithm, or here's the simple formulaic model of how much to own in equities, how much to own in bonds, and ultimately, does that ever turn? Or do we? Because at some point we lose the price discovery mechanism, right? That's what we hear about financial markets, right?
Right.
And if we're all just kind of buying indices or doing the same type of trading, we lose that, right?
Yeah.
So what do you think about that? Because I see this too in a lot of the ESG stuff that's out there, the economic and social governance out there, where people are saying, well, index funds are destroying it, that these people don't have good social responsibility and governance. And ultimately, it's all the index funds that are blaming it. So would it be something like that there's this upheaval of thinking, maybe with the newer generation come in, or how do you see that changing?
Yeah, so...
or does it not? Do we just continue on? No economic expansions forever?
No, for expansion for now. But I think that to put some numbers on it, just to repeat something I said at the roundtable, the perfect instrument for the modern wealth manager is the exchange-traded fund, the ETF. Because now they can structure a portfolio. They can go. I could be a one-person shop myself, and I could invest your money, and I say, you need to have some of your money in stocks and bonds and alternatives and international and in emerging, and I can now put together that portfolio for you using ETFs. 10, 20 years ago, I needed to work for a very large bank that would have very expensive departments that would have all of those things for me to put it together. So that is mushroomed out the advisory committee, and the statistic I threw out is there's 13,000 advisory firms in the United States.
Firms?
Yes, firms. Half of them have 2 people or less employed. They have
the old joke about 2 guys in a Bloomberg. Huh?
Yeah, exactly. Right. Exactly. 2 guys in yahoo.com now.
Right, it's not even a Bloomberg because they can't afford it.
Exactly. And then 440,000 registered advisors managing 43 million accounts, and the net worth, not what they manage, but the net worth of those 43 million accounts is the majority of the money in the United States. So it has become a dominant force, and they've got everybody in some version of the 60-40. What changes that? I'll go back to what we talked about before, inflation. Right now, the 60-40 portfolio is working tremendous because stocks go up, bonds kind of do this, stocks go down, bonds rally, and a flight to quality. And that seems to work over and over again. Last year, 2019, the 60-40 portfolio returned its best return since 1997.
It's like north of 20%, right?
Yeah, it was like 21% or something, depending on how you define it, and stuff. If you get inflation, and you go back and look what happened when you had inflation in the 70s and 80s, stock and bond prices go down. They both go down together. That would be the shock. Because
we had some of that in the 90s too. People forget that, where the correlation was positive to both sides, both the up markets and the down markets too.
Right. The negative correlation to price that we've had really started following the 98 financial crisis and the 2000 tech bubble. In that period is when it turned, and it's been positive ever since. And I like to say that the rude awakening will be when you get inflation, is they'll call up their wealth advisor and they'll say, "How do I make money?" And the answer can never be, "You don't. You just lose it," because everything goes down.
And then everybody wants to pull their money out. But when I went to school, we were not taught that inflation is positive for stocks. I hear that a lot from people anymore. It is true if you have purchasing or if you have pricing power and you can and use that transmission mechanism. But I would argue in this economy now, it's very difficult for people to pass on that inflation, right, or that pricing power. So I don't know. I just hear it a lot from advisors, from clients that, oh, well, we own stocks for inflation hedge. It's like, well, maybe in the medium term, but there has to be this repricing mechanism because the earnings are going to get hit.
So they forget in the third part of that equation, and that's multiples. And that, in the 1970s, stocks worked well as an inflation hedge because the multiple, the PE ratio, was 5.
Sure.
It was 6. Now it's 21.
Right.
And you can't buy a 21 PE company and say, oh, and if we get inflation, and remember, inflation is supposed to raise everything, your costs, and your product pricing and everything else on down the line. That's not a good inflation hedge at 21. Now, if it goes back to a 5 PE, which is a nice way of saying it goes down 80%, then it's a good hedge for inflation at that point.
Well, isn't this also, when you think about this too, you'd mentioned this correlation on price side because of the yield component. But this was the advent of risk parity as well. Like, you think about the Bridgewaters, the AQRs of the world that created this idea of risk parity. It's all predicated on this correlation, right? And so does it get exacerbated, in the next, if there is this inflation where bond prices start to go down, stocks go down, and then what do you do in all this rebalancing? Well, I think it's a rebalancing where people walk away like they did in the last crisis.
Yeah, exactly. And you've seen that because if you go back to the fourth quarter of 2018, the Fed raised rates, stock prices fell 20% from September to December. That's the S&P 500 that fell 20%. And bond prices didn't do a whole lot.
Yeah, they didn't really until like the second half of the quarter, right? It was like in the middle of November. They kind of started to rally a little bit.
Right, and they didn't do a lot. And I would tell you that in that period, there was some real angst. Oh, God, this is bad. This is really terrible. But then before you had a chance to, hit the panic button, here comes Jay with his pivot on January 4th. We're going to be patient and flexible. Right. And the Dow was up 1,000 points that day.
Right. And he brought the Uber Doves in. He had Bernanke and Yellen together, right?
Exactly.
Right? Yeah,
exactly. And he basically signaled to you that, I'm the snowplow Fed. I'm going to clear out every problem that you have and then get mad when you tell me that I do it. And that's what they did. And before anybody got a chance to panic, it all reversed and it went back. And then 2019 worked very well. Inflation would do it. And again, inflation, 180 on core PCE, that's their target, that's their measure. 225, 250, especially closer to 250.
250,
that would do it. Because I think there'd be a lot of people listening to us going, inflation, 1980, 12%. No, 250. That's all you need. That's all we need.
Then when we talk about the return of inflation, I'm like, what if we ever saw a 3 handle again?
Oh, yeah, we'd be panicking. We'd be panicking. Remember, if you're really old enough and you remember wage and price control by Nixon in the early 1970s, what was the intolerable inflation rate that they actually instituted a form of socialism that said you can't raise prices anymore? It was 3%. It was 3% that panicked everybody into him putting in wage and price controls. Well, we're kind of at that point now. If we ever saw 3%, that's a big deal. I know it's not 1980, but it's 2020, and it's a different environment altogether right now.
Right. So back to the bond argument, too. Why are investors accepting a zero or a negative real yield, depending on what measure you use? Let's say on the 10-year note today, right? I mean, you're talking about a 180 core PCE. Core CPI is what, 2.3 running right now. If you use headline, they're roughly the same because of commodity prices. But why are investors accepting that kind of erosion of purchasing power? Is it just the robo-advisor type of model? It's this variation of the 60-40? Is it that people are panicked out there? They just need safety? It just doesn't make sense if we have such a good economy, why we have to have negative real yields.
Yeah. First of all, negative real yields, to put some numbers on it, they're pervasive everywhere on the planet. Mm-hmm. And there are, by some measures, I mean, I've got some measures of real yields, thank you, Bank of England, that go back into the 17th century. And this is about as extreme as we've seen in terms of breadth of negative yields. I mean, yeah, they spiked down to larger negatives on the 30-year in 1980, but going the whole yield curve in all the countries at the same time, as far as breadth goes, it is negative. I think it is part of, you're right, the robo-advisor, the aging of the population, that they want to own something of safety. This aging of population, this demographic argument for buying bonds, it existed 15 years ago. Mm-hmm. 15 years ago, Bernanke coined the phrase savings glut. He was 100% right about that. And Wall Street said, yes, you're right, Ben, there is a savings glut and everybody wants yield. So we're going to take these subprime mortgages and chop them up into little CDOs, and we're going to then sell these to the Swedish pension plans because they could get yield, and the rating agencies are going to assign a AAA rating for it. And then in 2008...
And we're going to get our leverage from Iceland, don't forget.
Right, exactly. The fishermen, this is way better than being a fisherman. And then it all blew up spectacularly in 2008. So what happens now is people look at the 40 leg and they go, boy, I'd like to get some yield. Wait a minute, I don't want that. Don't tell Wall Street I want that yield stuff, because they'll come back to me with those impossible to understand structures that just created all the havoc in the first place. I'll just buy these negative yields. And what they've gotten away with, and I'll remind everybody, I'll use an extreme example. If you talk to pension plan or pension managers in Germany, and I've talked to a couple of them in Germany, how do you guys deal with negative rates? In 2019, the answer is best year I've ever had. Have you seen my total return?
Right.
And my total return is fantastic. I was like, yes, but then...
But what do you do on a go-forward basis?
Yes.
Right? Yeah, right.
When you mark your portfolio on December 31st with a bunch of negative yields,
Yeah.
And then, I one time had a hedge fund one time talk to me, this was a dozen years ago, and he referred to, because they're all focused on their 2 and 20 model to make their 20, that's a January problem. That, right now I have to get to 12/31, I have to book that big number, I have to get my incentive bonus of 20%. Right. Yeah, I'll start with my foot in a bucket in January, but that's after I got paid.
After I got paid, yeah. So it's incentives in the system, right? Yeah,
so that German pension manager is probably still celebrating that bonus check he got 3 or 4 weeks ago.
Right.
Ask him about April, May, or June. What do you think now? And I think he's going to have a very different response. So I do think that it is part of that. I don't want structure. I do want safety, that the total return has worked. But you're right, on a go-forward basis, unless you want to make the case that the next stop is -3, -4, -5, okay, if we go there, not only
you're going to make a killing on it.
Yeah,
right?
You'll make a killing on a total return, but then, as I like to say, you will make a ton of money on total return until the moment your bank goes bankrupt and you don't get your money back, because they can't survive that system as well, too. So it's going to be difficult going forward. And I think that's why the screaming about negative rates really is ratcheted up in the last 2 or 3 months. Whereas, remember, it was August, September when you hit that 17 trillion of negative rates, that you didn't see that. And I'm using negative rates as an example for the real rate argument.
Sure.
But again, I think the real rate argument is there's just such a demand for securities right now.
It's pretty amazing because you talk about the negative real yield, right? So you just talked about negative rates, negative nominal rates. So you are guaranteed to lose money if you buy a negative yielding bond and hold it to maturity. That's one thing compliance allows me to say. It's the only guarantee I can give, right?
Right.
But the thing about it is that it's amazing that the central banks target this negative rate. So they're saying, look, we're going to tax the wealthy or tax the saver, right? It's not the 1%ers. It's people who are the savers. Again, depending on how much, you got to have at least 300,000 euros. However, we're also going to target a 2% inflation rate. So we're going to blatantly take your money. Then we're also going to let the invisible hand of inflation erode your purchasing power as well. And people are just saying, give me more, right? So I think you're right that at some point that people are going to look at their statements, whether it's the pension manager, whether it's the end client, and they're going to say, well, why am I buying this negative yielding stuff? Because people get myopic when they do portfolio review. Look at this negative sign right here, right? And I'm not talking about the yield, I'm talking about the total return. Because if rates don't go down, you will have a negative rate of return. They have to continue to press down if you have a negative yielding bond, right? That's just the math. So is that like some reflexive thing if we just stay here?
Absolutely. I use this story that I'd like to tell that we're here in Chicago, and it happened just literally a couple blocks from here about 4 or 5 years ago. I was standing on a street corner, and I'm just waiting across the street. And some guy walks out in the street and gets hit by a car. Now, he wasn't hurt, but he just walked out in the street, got hit by the car, and exchanged a bunch of colorful language with the driver, dusted himself off, and moved on. But what I remembered was I'm sitting there staring at it, and he was like 10 feet away from me, and he walked right out. And I should have yelled, watch out, look out. But my initial response was, am I seeing this right? Maybe the angle's wrong. Maybe he knows the car's there. Maybe the car knows he's there. And while I'm processing this, am I seeing bam, it happens all over. That's this negative rate environment. Is this really happening? This can't be happening. Maybe I'm looking at this wrong. Maybe it'll go away. And then the next thing you know, you're stuck in this gigantic morass of negative rates is where we are. I used the example once. I talked to a bank in Europe, and I said, you guys have a stock loan department where you lend securities. Yeah, you lend securities at negative rates. Yeah, you lose money on every security you lend. Yeah, why do you keep doing it? Because it's one of our business. It's what we do. That's what we do. It's one of our business models. We can't fire everybody and send them away to be Uber drivers for 2 years and call them back when we get positive rates. So you're like me staring at this guy about to get hit by a car. You don't know what to do. I think we are at the end of that phase that we're about ready to yell, hey, look out, this is not good. So I do think that there was some of that initial, this can't be happening, and stuff. Because
you're making money on it. Yeah. And that's the crazy thing too. I mean, when the German Bund, the bottom in yield was like what, negative 77 or 76, something like that. Yeah. And then it's like, well, the whole time, your total return, you were up like 10%. That's
great. Buying
something, if you bought it like a year earlier, because it was roughly 70 in the positive direction. But then all of a sudden, this mark-to-market comes back, and I just felt like it would wake people up a little bit. But I think you're right. It has to do it on a calendar year basis. We have this just process where we look in calendar years. We don't look at rolling periods or anything. It's not about these certain metrics. We have to take these certain anniversaries. And I think that some of that got obfuscated last year because you had the deep negative, right? I'm calling negative 70 deep, unlike the IMF and the BIS. But we got back to like negative 30 roughly at the end of the year. And so it's like, okay, well, it was still a positive rate of return. They're not looking at that reversal over the what I call the max drawdown period, right?
Right. Greed takes over. And I'll give you a good greed story from today. So the day we're talking, Tesla opened up another 3.5% today, and it crossed $100 billion of market cap, passed Volkswagen as the second most valuable auto company in the world. Only Toyota is more valuable than it. Its market cap is nearly the value of Ford, GM, and Chrysler combined.
Yeah.
They're 108.
The rest of the U.S. automotive industry.
Yeah, they're 108, those three, and Tesla's 102.
Yeah. And how many cars do they make relative to the big three?
300,000 or 400,000 versus 10 million. For the big three. I think it's a bubble. I think it's way overdone. I understand the arguments about it being transformational, but even people I know that own it, like, is it a bubble? Yes, but not today. It's up another 3.5%. Not tomorrow. Right. It might be up another 4% tomorrow. At some point it'll blow up, but not now.
Right.
And that's what the pension manager in Germany was, and that's what everybody was. Are these negative rates awful? And yes, and yes, but look at my total return.
Right.
When do I sell it? But not now. It's going up. And stuff. But eventually, when it stops and the returns go away, I think then the grousing becomes larger and larger, and that's beginning now.
One of the beneficiaries, I think, of low rates has been corporate America. I mean, if we shift the topic to that, I mean, you've been tracking zombie companies for a while now. Can you talk about the state of health there?
And define a zombie company, too.
Yes. So corporate America. The interesting thing about corporate America, before I get to zombies, let me go off on this real quick. There is something like $600 billion of negative corporate bond yields in Europe and in Japan. 20% of that has been issued by American companies. They issue euro-denominated debt in Europe. It's been great for them because if you're IBM, you have 15,000 employees in Europe, and you can issue bonds in Europe at a negative yield, and you can finance your European operation at zero. In other words, you don't have to take a currency risk because you already have. If you're an American computer company maker, you could issue negative yield in Europe, but then you either have to take a currency risk or you have to hedge it back. And by the time you're done doing that, you're back to the same rate you'd be at in the U.S., and there's no point in doing it. So you're giving them a big competitive advantage. So to your first question, negative rates has been a huge boom for global companies, because global companies, big companies, means you have a European operation and or a Japanese operation. It's now costing you nothing to finance that. And if you have an American-only competitor, their cost of capital is significantly higher than the rest of the world as well, too, because that way you can get rid of that hedging. That breeds into the zombie companies, as you were pointing out, that we do track the zombie companies. I think it's around 15% or so of the companies are zombies.
Is that of publicly listed companies?
These are publicly listed companies that are losing money, and they are staying in business because of very low interest rates. And so that number has
So it's not
been
just
going up.
losing money, but it's that, isn't there a further debt? It's not just that it has negative earnings, right?
Right.
It's they have less than, what is it, the debt service? Or how do you define that?
Right.
Yeah, completely.
They are losing money. They have less than the interest expense that they need to maintain. That sounds like they should go out of business. But given the liquidity and the low rates, they can constantly refinance. We're here in Chicago. One of the most bankrupt pension plans in the country is the
Congratulations.
It's the Chicago Teachers Plan.
Right.
But Ernest Hemingway says, how does one go bankrupt slowly, then suddenly? And Chicago's been in the slowly phase for 30 years. Right. And it could stay in the slowly phase for another week or another 30 years, as long as they go to market, which the Chicago school system did last week. And they came to the market, I think it was $500 million, and people bought it.
Yep.
And as long as they buy it, you could say, my numbers are terrible, doesn't matter. I show up with a bond issue and you buy it, I live another day. And that's what happens with these zombie companies. Their numbers suggest they should be going out of business, but they come with another bond offering and it gets bought, and they stay in business. Well, when the cycle turns and people don't want that, or the rates go up that you can refinance, but you can refinance into significantly higher rates and it doesn't matter, they're going to have problems, but they're not now, and that's kind of...
It's kind of on your still greed argument,
yeah,
right? It's like
it's
not
like
a problem
Tesla.
today.
It's like Tesla,
Right.
Is it a bubble? Yes. Is it overvalued? Yes, but not today.
Right.
And that's kind of the way that the greed is when it comes to that stuff.
Yeah. So what is your outlook for earnings for this year? So do you think that corporate America gets off? Last year is going to be, it looks like it's going to be slightly negative according to FactSet if you use those estimates for the fourth quarter. Are we set up poised for a rebound in earnings this year, or is it just going to be more trudging along, a lot of M&A type deals? How do you think about what's going on in corporate America and the activity there?
You're right. Earnings were negative last year. The market is supposed to lead earnings. Yep. It is up big last year on an idea that they're going to rebound. By all indications, we'll probably be low single digits by the middle of the year, say 3 to 5% growth. And I tend to lean towards the lower end of that 3, but a positive. I've asked the question, is that enough for a 31% stock market gain last year? That they're anticipating a rebound in economic activity, which will lead to a rebound in earnings, which will keep the multiples from expanding and maybe even compress them a little bit. Is 3% enough? I don't think it is. There's a little bit of hope in that number that maybe we could squeeze out something better. Maybe a rebound in Europe can get the earnings, because remember, 40% of the revenues of S&P 500 companies comes from overseas. Give me a global rebound. Maybe we could squeeze out a little bit more out of that number as well too. And then maybe, as you pointed out, we could do a little bit of alchemy with some M&A or some spin-offs or divestitures or something like that to kind of keep our numbers going. And then lastly, don't forget who's been the big buyer of stocks since the financial crisis, and that has been corporations themselves through buybacks. $5 trillion has been bought back. So we could do the IBM thing. And what the IBM thing is, IBM's earnings kept, I know they reported yesterday a very good number, but before that, IBM's earnings and their revenues struggled. Why didn't the stock go down? Because from 2008 to 2017, they reduced their float by nearly 50%. They just kept sucking up all of their stock. As I said, the company's worth $22 billion. Pretty soon there'll be one share of value with a price of $22 billion.
Does anyone even issue stock anymore? Does that ever happen anymore? Like, secondary offerings? Do you see that anymore?
Not secondaries. Yeah. They try to do initials.
Right. And those tank.
Those tank, right. Exactly.
Yeah. All the value's been extracted by the VC and the PE firms.
Right, exactly. And so, but no, nobody does. But so there is that hope too that the struggling earnings, let's call it profit, net income, will be met by a falling denominator of earnings, number of shares outstanding to hit the EPS to keep it going higher. And that has been a big driver of EPS this cycle, is that if you looked at the profit numbers or if you looked at the earnings numbers, in fact, FactSet did this late January in one of their reports. They looked at profits or margins versus EPS, and the margins and the profits are going down.
But
EPS has been holding up better. I mean, it's still negative in the fourth quarter, but a lot better than profits because we just continue to shrink that base. Buy back more stock. The tax, I should say in fairness, the tax code does incentivize you to do that.
Right.
If you have money and you give it out a dividend, it's taxed.
Taxed, right.
But if I just hoover up all my stock and squeeze the price higher with a low share outstanding, there's no tax unless you sell it on a capital gain. So the tax incentive is definitely there to do that.
All right, we're getting up on the end of time here, but before we do that, I want to ask you, what's a big risk that you think the market is ignoring today? What's something that's on the top of your mind from a risk perspective that isn't getting much play, or it's not something widely discussed that you want to tell our listeners about today?
The election. And I think that the election, I think there's a perception that you're going to get either Biden or Trump as being the president, meaning if anybody else wins, Sanders, well, then Trump's going to win in a walk. And if Biden
that's the assumption that, the socialists can't win.
The socialists can't win.
That's how we ended up with Trump, though. It's like there's no way Trump could win. Right, so maybe you have that revisiting that again.
Or if Biden is the nominee, everybody exhale because he's a moderate and he won't be so bad. I think that the mistake in there is that either a Sanders gets the nomination, and I think there's a realistic chance that he can, look at the betting markets and stuff. And he'll
polls, he's polling very well again, right?
Right.
I saw the new polls,
He slipped a little bit in some recent Iowa polls. And the bet with Sanders, if you look at the betting market real quick, is that he leads in Iowa, New Hampshire, and Nevada, first three races.
Yep.
The bet there is the whole month of February 3rd starts Iowa. The narrative is going to be Bernie wins, Bernie wins, Bernie wins, and Bernie's there with the balloons coming down saying, thank you, thank you, thank you, and then we start writing the stories, can Bernie be president? And what's wrong with Joe? Why aren't you winning, Joe? Oh, but I'm going to win all these other races later on. Yeah, well, by the time we get there,
you won't be in there anymore,
yeah, exactly.
Right?
The momentum could change. But if Joe were to upset right away, he could just wipe it all out before it starts. So I think that there's a realistic chance that Bernie can win. And then I would not immediately say, well, that's it. The commie can't win, become president. Be careful on that one. If you look at the economic modeling that anybody's done, here's what the economy's doing. First-term president, he should be at a 60% approval rating, talking about a 49-state landslide. He's 50-50.
Yeah.
And so he's vulnerable.
Yeah.
I'm not saying he's going to lose. He's vulnerable. And if Joe wins, I think that the mistake they're making about Mr. Moderate Joe is I think that the tug from the left on his party is going to be so strong on him. He won't be Bernie. Right. He won't be Warren, but he'll definitely be a little bit more left than you think. So,
and he'll probably bring someone that's pretty left as a running mate.
Yeah,
right?
exactly.
Right.
Exactly. So I think that, there's this perception that, like people have said it to me, the election's a non-issue because it's either going to be Biden or it's going to be Trump. Mm-hmm. Trump is a known quantity. Right. He's got warts, but he's the devil we know.
Right.
And Biden is the safe moderate. And maybe we just it's going to be Joe against Donald, and therefore we could just ignore it altogether. And it's like, well, first of all, that might not happen. Second of all, be careful. I don't think that Joe is going to be as milquetoast as you think he is. So I do think that we're not really focusing on the election yet.
What I was going to ask about that too, do you think there's an impact to a state like California moving its primary up too? Do you think that brings more political willpower in here where California gets to kind of push the what would be the candidate on the Democratic Party?
Yes, because let's go back to the betting market. Let's say that Bernie wins Iowa, New Hampshire, Nevada. Nate Silver, 538, has been jumping up and down on his website saying there is no such thing as momentum. I kind of disagree with him. I think that there is.
Did he go to Chicago Business School or what?
He actually did. He graduated from the University of Chicago.
That's a factor joke for our people who don't know where we're going with that.
Right. Yeah. He actually wanted a job as a sabermetrician, which is a baseball for the Chicago White Sox. They told him no, and the rest, as they say, is history. Otherwise, he could be sitting there for the White Sox trying to figure out how to win a World Series for him. But he doesn't think there's anything as momentum. I'll disagree with him. But Bernie is also leading big in taking California. Mm-hmm. So if you get Iowa, New Hampshire, Nevada, and then you go, oh, yeah, but Joe's got all these other ones. Then the next thing after that, Super Tuesday, the biggest prize in Super Tuesday is California. Bernie gets the biggest prize. Joe might win more states, but then what's the narrative the next day? Bernie wins California. Right. The story of Bernie being president doesn't stop. Now we're 5 weeks into this, and all of a sudden, oh man, this guy could actually wind up being president at 79 years old. Yeah.
Well, he also, he had momentum in the last election too. I contended that if he'd have started earlier, raising money a little bit earlier, because he beat Hillary in pretty much like the last 20 or so states.
Right.
Too. He had a lot of momentum. So, and people seem, even though Mr. Silver says there's no momentum, people like voting for the winner.
Right.
Right. People, there's something about like, oh, of course, I'm with Bernie. He's winning. Right. Like it starts to change the psyche. I'm saying.
That's where I'll disagree with him. Yeah. Is that I think that there's a lot of people still today that view election as like a contest, that I have to win. Right. I have to pick the person that is going to win, and that makes me okay. That these same people are very uncomfortable with picking a third-party candidate or something, because then why'd you do that? Oh, I know. Don't ask me why I did that. I just want to be safe and pick the winner. Like, no, this is not betting on the Super Bowl. Right. But they view it the same way. That I'm going to take San Francisco because they're the favorite, and
they're not the favorite. Actually, the betting market has them as a 1-point dog, which I think is disrespectful.
Yeah. Okay.
I'm a Niners fan though too, but I think it's disrespectful for how good that defense is. And anyway.
Yeah. Or maybe they like Mahomes, but we're going off on another
another direction. Let's go back to politics, which is safer.
Yeah, so I do think that the momentum, I think the momentum's there, and if Bernie takes California, the momentum continues. Yes, you could look further down the line at some of the polls for the states that come in late March and in April and say, Joe's leading, Joe's leading, Joe's leading, Joe's leading. Yeah, well, give me a half a dozen contests in Super Tuesday with a bunch of Bernie wins. Go back and check then after that happens, and I'll bet it'll be a far different scenario altogether as well.
So let me just ask then, do you think Bernie is the guy that the Dems are going to put up? Or what do you think? You've been talking about the brokered convention too, right?
Yeah,
so
yeah.
Maybe you can explain that to our listeners as well.
The brokered convention is if the Dems changed their rules after 2016. The Republicans did this 20 years ago. When you have a primary and you apportion the votes out of the primary, in the first round of on the election, that's the way everybody's got to vote. So if you're an elector from or a delegate, from Iowa, and they said, Joe gets X and Bernie gets Y, well, that's the way you vote on the first ballot. They got rid of superdelegates. Superdelegates was 20%. They're just the party poobahs, the Nancy Pelosi's. They get a vote. They're gone on the first ballot. So in order to win on the first ballot, you need to get 50% plus one of the delegates. If you have a Bernie winning and a Joe winning, throw in a Liz Warren picking off a few states here or there, or a Buttigieg picking off a few states here or there, you don't get 50%. You get what's called a brokered convention. The second ballot, now you're going to leave it. You're going to bring back the superdelegates on the second ballot, and you're going to start loosening the rules on the delegates from Iowa can maybe vote a little bit differently, because when you go to a second ballot, you can take anybody. So you could say, okay, first ballot, nobody got 50%. Let's go to a second ballot. And we all get together in the smoke-filled room, which, by the way, was developed in Chicago at the Blackstone Hotel, just not too far from here. The original smoke-filled room.
Getting a lot of history today,
in
too.
the 1890s. Yeah, I'm the Chamber of Commerce for the city of Chicago. But we could get together and we could say, okay, we're going to pick a popular Democrat. We're going to pick Michelle Obama. And we're all going to get together. We're on the second ballot. We're going to vote Michelle Obama. And everybody's going to be stunned. And before they can ramp up their opposition machine and stuff, 90-day sprint right to the finish. Everybody loves her. They vote for her. Before we realize what happened, she's president of the United States. I'm not saying that will happen, but that's what would happen in a brokered convention. Anybody can be picked then.
Not even a candidate that's in the
Not even a candidate that's been
Which is
running.
why you use the Obama example, or is that just your Chicago heritage?
Right, yeah. Well, right. Michelle is considered one of the most popular Democrats right now. And I would argue that's because everybody loves the First Lady, because she doesn't tax you, she doesn't regulate you, she doesn't do anything to you. So we all love the First Lady. It's when they start doing all those things to us that we have a different opinion. About them. But so the reason I picked her is because, according to the polls, the most highly thought of eligible, because Barack's not eligible, eligible Democrat is Michelle Obama. So that would be the argument. She doesn't want to run. I mean, for everything I've read, she doesn't want to run because it's ugly, it's terrible. They say nasty things about you. But what about a 90-day sprint right to the finish? And stuff like that. But you got to get to a brokered convention. You got to get to a brokered convention first.
All right, so the question is, are we going to have it? Are we going to have a brokered convention, or do you think that we're going to get actually someone out of it through the primaries?
Well, in order to get a brokered convention, you need a third candidate, because if it comes down to a two-horse Bernie Biden race,
then someone, by definition, gets more than 50. Yeah.
So you're going to need a Warren or a Buttigieg to pick off half a dozen states. Maybe get a big one, down the pike or something like that. Like a Warren takes a New York or something like that in April. Okay. I would say to you, I don't think we're going to get a broker convention, but there's a good chance of it. I think what I'll be watching for in Iowa and New Hampshire is, does one of those other non-Bernie, non-Biden candidates actually show that they've got some legs? Because what usually happens after Iowa, you finish fourth place, your funding, your fundraising goes to zero, and you're out of the race in 2 weeks. But if you can stick around with your funding and maybe pick up delegates, you could deny somebody else that 50%. So you absolutely need a third, or even better, a fourth real candidate that they just remember 4 years ago. We thought there was going to be a brokered convention because we had 430 Republicans running against
They just
Trump.
change each week.
Yeah, exactly.
Right. Yeah.
But what happened was they all fell away right after we went from like literally like 15 or 18 candidates down to 3 within 2 weeks after Iowa. It was Rubio, Cruz, and Trump, and then we went to 2, and then Cruz lost out because remember what typically happens is the last 20 races or so, the second place guy loses money and can't campaign. So the guy that's left gets 80% of the delegates on the back end, and then that pushes him over 50%. So you need somebody to kind of hang around is what you need. The Democrats structurally have got this thing where they get all their money. Bernie's always saying that the average donation is $27 and stuff because they all go to his website and give him money. That means he's got staying power. He can lose, and he keeps getting money, and he keeps sticking around the race. Where if the Republicans are a little bit more corporate types, the corporate donor types run away, and you're
they need the winner. They need the winner to get their lobbies and everything.
Exactly.
Right.
I didn't give you money. The corporate types, I didn't give you money because I like you. I'm hedging my bets. I
Correct.
give everybody money. Win something and you'll get more money from me. Well, I can't win unless you give me money, and that's the catch-22 that they wind up in as well too.
Sounds like Bloomberg has some staying power ability within that equation, and it also sounds like Hillary has a chance on that 90-day sprint. Then,
if she could get the delegates to, I don't think she's liked enough. But
Even within her party,
Bloomberg is going to be an interesting case where he says he's willing to spend $2 billion just to not elect Trump. Not only just he's promoting himself.
Mm-hmm.
I don't know. I don't know if we know what that means because in this era of elections, I used to argue that money, and I've seen others say this too, money doesn't matter as much because all you need now is $60 a month to pay your Verizon account and make sure that you've got your Twitter handle going. And between the free publicity, and if you're Trump, between the free publicity and 71 million people on your Twitter account, boy, you used to pay how much to get that kind of exposure in the past that now with your phone in 15 seconds you can get that. So I don't know if Bloomberg's $2 billion is going to have the oomph it would have had 15 years ago. Mm-hmm. Boy, that would have been the game changer on top of game changers 15 years ago. It still might be. But in this social media era, I wouldn't be surprised if you find out that was largely wasted money at the end of the day, that maybe Trump still loses, but it didn't matter. Bloomberg's wasn't his money at the margin. Because what is money? Money is just 10 million commercials. Does anybody watch commercial television anymore? I mean,
I'm only forced to during sporting events.
Exactly,
Right.
exactly. I don't see Bloomberg commercials or political commercials streaming on Netflix or streaming on Amazon Video.
Well, come to California, we don't get a lot of ads anyway.
Yeah.
It's very, very few that people spend money out there.
Right, they don't spend money here either because we're such a Democrat state, But if you go north here about 80 miles up to Wisconsin, oh my God, they're just being buried with those ads right now. They can't stop seeing them as well.
All right. Well, Jim, we could keep you here another few hours, but in the interest of time, before we let you go, let's do Sam's favorite part of the show.
Okay.
And see how our brains are clicking today.
all right, Jim, and you're a veteran at this by now, but for our listeners who may not be, that favorite part of the show is Sherman Says. And what I'll do is I'll offer up a series of prompts alternating between Sherman and Jim, to which they'll provide a top-of-mind response. And the joke has always been we're going to try to keep these responses to one word. We'll see if we can achieve that today.
It's not a joke.
Well, it hasn't worked yet, I don't think so. Let's start off with Mr. Sherman with U.S. infrastructure.
Crumbling.
Jim, money market funds.
Going up.
Tax cuts. Or hikes.
Unlikely.
I was going to say that too.
Robo-advisors.
Big.
Central banks.
Huge.
Shale oil.
Shale oil for me?
Yeah.
Shale oil. Very important.
Bubble.
Gum.
Core PCE.
Low.
Indexing.
Popular.
Fed put.
Exists.
All right.
All day long, right? Well, Jim, we appreciate it.
Yeah,
Thanks
thank
again.
you.
Thanks for coming over and visiting us on this, as you called it, very warm day in Chicago. When I
25 degrees.
Yeah, when I say things with a 2 and a 3 handle, that's not the first thing I think of as warm, but we appreciate it. Again, it's always a pleasure talking to you. If you aren't familiar with Jim's work, Bianco Research through Arbor Research, great stuff. Got a great team there, puts stuff together. So, how can they follow you out there, Jim?
At Bianco Research on Twitter, or biancoresearch.com is our website.
Okay. So thanks again for coming by.
Thank you.
You can get this on iTunes, the DoubleLine website, Spotify, Stitcher, I think nowadays. We're on YouTube, as you see, youtube.com/DoubleLine Capital. You can see Jim and our other roundtable guests that we just had. But it's kind of amazing. We did it at a rectangular table. We called it a round table. And here today, we actually have a round table. So we finally achieved that goal. So anyway, thanks again, Jim. Thanks for tuning in. And check out the next episode coming soon.
Thank you.
All right.